Ladies and gentlemen, if you look beneath the surface of the global financial system, you'll notice something most people miss. It's subtle at first, but once you recognize the pattern, it becomes impossible to ignore. We are entering a period where the amount of money moving toward gold and silver is not driven by emotion, headlines, or speculation. When you study the mechanics of long-term financial cycles, you begin to recognize that major shifts don't happen suddenly. They build quietly, layer by layer, until the pressure becomes impossible to contain. What we're seeing right now is one of those shifts, a massive liquidity wave forming beneath the surface of the global economy. And like every major liquidity wave in history, it begins where most people aren't looking. It begins with the growing gap between what countries owe and what they earn. When nations accumulate debt faster than income, they eventually reach a point where servicing that debt becomes increasingly difficult without altering the value of their money. This isn't speculation, it is the recurring pattern across centuries. Policymakers always face the same set of choices: allow painful austerity, default, or increase the supply of money. And almost every time, the path of least resistance becomes creating more liquidity. Not because anyone wants to, but because the system leaves little alternative. When economies slow, governments spend more. When debt burdens rise, central banks ease monetary conditions. The intention is to keep growth alive, but the side effect is always the same. More money enters the system than productive output increases. This new liquidity doesn't spread evenly. It pools. It moves through the system in waves. At first, it shows up in financial markets. Equity prices rise, not necessarily because companies are becoming more productive, but because the discount rate on future earnings falls. Bond yields decline because central banks suppress rates to make debt service manageable. Real estate appreciates as borrowing becomes cheaper. People feel wealthier, and that creates a sense of relief. But beneath that surface comfort lies a structural imbalance. You cannot increase money faster than productivity forever without changing the value of that money. The next phase is when real yields move into negative territory. That's when the incentive structure shifts. Holding cash or bonds becomes increasingly unattractive because they lose value in real terms. Savers begin asking themselves a simple question: where can I preserve the purchasing power I already have? Historically, when that question enters the collective mindset, capital begins to migrate towards scarce assets, those that cannot be created with a keystroke. You see this transition not only in individuals, but even more so in large institutional players. Pension funds, sovereign wealth funds, and central banks adjust their portfolios quietly and gradually. They don't announce it. They simply respond to incentives. This is where the liquidity wave transforms into something much larger. When big players expect others to shift into stores of value, they move earlier. That is the essence of game theory in financial markets. The expectation of movement becomes the driver of movement. If you wait until everyone sees the wave, you pay a significantly higher price. So the rational behavior is to act before the wave crashes into public awareness. That early positioning magnifies the wave when it becomes visible. Liquidity moves faster than most expect because everyone is trying to get ahead of everyone else. The geopolitical environment amplifies this effect. As trust between major powers declines, as alliances shift, and as global coordination weakens, countries seek assets outside the control of any one nation. Historically, this has always pushed capital toward commodities, reserves, and tangible stores of value. Gold becomes a neutral asset in a world of rising uncertainty. Silver becomes the beneficiary of both monetary demand and industrial demand. When liquidity expands and trust declines, the gravitational pull toward these assets intensifies. At this stage, the wave is no longer theoretical. It becomes visible in capital flows, in reserve strategies, in changing investor allocations. The signals appear everywhere for those who know where to look. But they don't appear with announcements or warnings. Liquidity waves are quiet until the moment they're not. The important thing to understand is that these shifts are driven by structural forces, not emotions. They're driven by incentives created by monetary policy, debt burdens, and global realignments. And once those incentives line up, the movement of capital becomes almost unavoidable. You don't need predictions. You only need to study the mechanics of how systems behave under pressure. What lies ahead is not simply more money entering markets. It is a reordering of value fueled by the mismatch between financial promises and real-world productivity. Every major liquidity wave in history has created both risk and opportunity. Those who understand the mechanics position themselves early. Those who ignore them react when it's too late. When money begins to lose purchasing power, most people first feel it through small frustrations. The cost of everyday items rising just a bit faster than their income, savings not stretching as far as they once did. The subtle realization that the same amount of money buys less than it used to. But beneath these surface-level experiences lies a deeper and more structural reality. Throughout history, every time the value of money weakens, capital naturally seeks alternatives that can maintain their worth over long periods. Gold and silver become the primary beneficiaries of this shift, not because of myths or sentiment, but because of their unique roles in the monetary ecosystem and the incentives that guide investor behavior. The first principle to understand is that money is only as valuable as the trust people place in its ability to store value over time. When governments expand the money supply faster than productivity increases, the supply of currency grows while the supply of real goods and services does not. The inevitable result is a decline in real purchasing power. This isn't a modern phenomenon, it's a recurring pattern across centuries. When currencies are debased, intentionally or unintentionally, people look for something that cannot be manufactured at will. Gold and silver fit that requirement perfectly because their supply is constrained by natural limits and the difficulty of extracting them from the earth. Money that loses value creates incentives. Investors don't move into gold and silver because they suddenly decide to be conservative. They move because the alternatives become unattractive. Bonds, for example, offer fixed interest payments. But if inflation rises faster than the interest rate, those bonds deliver a negative real return. Cash sitting in a bank account loses value every month. Even equities, which can be strong performers, become vulnerable when inflation volatility creates uncertainty around future earnings. In such an environment, capital begins to rotate into assets that have historically resisted the erosion of value. Gold's primary advantage is that it doesn't depend on anyone's promise. It is not tied to the performance of a company, a government, or a financial institution. It is simply a form of money that has survived thousands of cycles, regimes, crises, and monetary resets. This independence becomes incredibly valuable when the purchasing power of fiat currencies is being diluted. People begin to realize that holding an asset with no counterparty risk is a form of protection against systemic instability. Silver behaves similarly, but with an additional layer of complexity. While it is a monetary metal like gold, it also serves a crucial industrial role. As economies evolve technologically, silver becomes even more indispensable in areas such as energy systems, electronics, and manufacturing. When the price of money weakens, the monetary demand for silver rises. When technology expands, the industrial demand rises. This dual demand structure creates a unique pressure that magnifies the metal's sensitivity to monetary conditions. Historically, silver tends to move more explosively than gold when capital seeks refuge. Another important dynamic is psychological. When people lose confidence in the purchasing power of their currency, they begin to act defensively. They look for ways to preserve what they have. That instinct becomes powerful when shared by millions of individuals and by large institutions. Gold and silver benefit not only because of their intrinsic properties, but because of the collective behavior that emerges in times of monetary stress. When a large group of investors anticipates depreciation, they move preemptively. This early movement reinforces the trend and accelerates capital flows toward metals. When central banks themselves begin purchasing gold, something that has become more common in recent years, it sends a signal that the biggest players in the financial system are also seeking protection from the weakening purchasing power of money. Central banks do not buy gold because they are speculating. They do it because they understand the long-term consequences of monetary expansion better than anyone else. Their actions are not emotional, they are strategic. The most consistent lesson across history is that when money weakens, alternatives strengthen. Gold and silver have no political allegiance, no reliance on credit, and no vulnerability to the decisions of policymakers. Their value is rooted in scarcity, in universal acceptance, and in their resistance to dilution. When currencies decline, these qualities become indispensable. The decline in purchasing power is not just an economic event. It is a signal that the monetary environment is shifting. Those who recognize these signals position themselves early. They understand that gold and silver are not investments in the traditional sense. They are insurance against the loss of monetary value, anchors in periods of distortion, and safeguards during transitions. Whenever money loses strength, these metals reclaim theirs. Investor behavior may look emotional or unpredictable on the surface, but underneath it is shaped by a structure of incentives that is remarkably consistent. Game theory helps explain this structure. It shows that markets move not only because of fundamentals, but because of how investors anticipate each other's decisions. In many moments throughout history, the biggest market shifts occurred not when the data changed, but when expectations about others' behavior changed. Understanding this dynamic is essential to understanding why certain trends accelerate faster than logic alone would suggest. In financial markets, every investor operates with incomplete information. No one knows exactly what every other participant will do. So instead of reacting purely to the present, they make decisions based on expectations of the future. When conditions begin to shift, monetary policy, inflation, geopolitical risks, investors try to gauge how others will respond, and that anticipation becomes its own force. If an investor believes others will move into a certain asset class, the rational response is to move first. The early mover gains the advantage, and the fear of being late intensifies the pace of the transition. This is where game theory becomes powerful. It reveals that investors don't make decisions in isolation. They make decisions in relation to each other. If central banks signal that interest rates will remain low or liquidity will expand. Large institutional players begin adjusting their portfolios ahead of time. They don't wait for the full impact to show up in economic data. They move when the incentives shift, and they move because they expect others to see the same signals and react accordingly. This behavior amplifies trends and often turns small shifts in fundamentals into major market movements. Consider periods when currencies weaken or inflation expectations rise. Investors know that holding cash or fixed income assets becomes less attractive when real yields fall. So the question becomes, where will others move their capital? If the collective answer points toward assets that hold value in inflationary environments, commodities, real assets, or precious metals, then early movement becomes a competitive advantage. The expectation that others will seek protection becomes a self-fulfilling process. When enough participants believe capital will flow into gold, silver, or other stores of value, the mere belief accelerates the flow. Another dimension of game theory is strategic positioning. Large players, such as hedge funds and sovereign wealth funds, understand that their moves can influence markets. They also understand that others are watching for signals. Therefore, they position quietly and gradually, giving little indication of their intent until their exposure is established. Once their moves begin to appear in market data, other investors interpret these signals as confirmation and follow along. The cascade effect is not driven by emotion, but by rational response to perceived behavior. This same dynamic occurs during periods of uncertainty, when geopolitical tensions rise, when supply chains become unstable, or when trust between major economies erodes. Investors know that risk increases. But the crucial question is not only how risky the environment is, it is how others will respond to that risk. If investors believe others will begin hedging, they hedge first. If they expect capital to move toward safe haven assets, they shift early. The logic is simple. In a game where everyone is trying to avoid being the last to act, the advantage belongs to those who move before the majority realizes the implications. Game theory also applies to policymakers. When governments or central banks signal their intentions, they influence investor expectations. If policymakers are expected to stimulate the economy, support markets, or weaken the currency to reduce debt burdens, investors position accordingly. They don't wait for official actions. They react to the expected path of policy, knowing others will do the same. This alignment of expectation often moves markets more than the policy itself. The most interesting aspect of game theory is how subtle but powerful it is. Markets can remain stable for long periods and then suddenly accelerate in a new direction. To an outsider, it may appear abrupt, but to those paying attention to the incentives, it becomes clear that the shift was building beneath the surface. Investors were waiting for signals, not just from the economy, but from each other. Once those signals aligned, movement became inevitable. In the end, game theory teaches a simple but profound lesson. Markets do not move because a single investor changes direction. They move because investors believe others will. The expectations become the driver, and once they take hold, they create trends that feed on themselves. Those who understand this dynamic are able to anticipate shifts earlier, not by predicting the future, but by understanding how incentives shape collective behavior. Over the past several decades, the global economy expanded under a framework of deep interconnectedness. Countries traded freely, supply chains stretched across continents, and capital moved across borders with unprecedented ease. That era produced extraordinary efficiencies, lowered costs, and created a sense of stability. But the trends driving that period have been shifting. What we're seeing now is a transition into a new phase, one defined by de-globalization, rising geopolitical tension, and a growing recognition that the assumptions of the last 50 years can no longer be taken for granted. In such an environment, hedging demand inevitably increases because uncertainty becomes structural rather than temporary. When relationships between major powers begin to break down, the first thing that weakens is trust. Trust is the foundation that global trade, capital flows, and reserve systems rely on. If countries are uncertain about the reliability of their partners, they start to protect themselves. They think more in terms of resilience and less in terms of efficiency. They build redundancies into supply chains, diversify reserves, and reduce exposure to foreign vulnerabilities. That shift changes the incentives for investors and nations alike. When trust declines, the probability of shocks rises, and when the probability of shocks rises, hedging becomes less of an option and more of a necessity. This process accelerates when geopolitical competition increases. As major economies move from cooperation to rivalry, supply chains become tools of leverage, currency systems become strategic assets, and access to technology becomes a point of control. Investors recognize that these tensions create a world in which disruptions are not rare anomalies. They are recurring risks. Whether it's conflict, sanctions, trade restrictions, or political shifts within countries, the range of possible outcomes widens. And when outcomes become harder to predict, the need to protect wealth becomes more urgent. One of the first responses to rising geopolitical tension is the diversification of reserves. Historically, nations that fear instability reduce exposure to assets controlled by rival powers. They look for stores of value that are neutral, universally recognized, and independent of political systems. Throughout multiple cycles, this dynamic has led to a buildup in demand for physical assets, especially commodities and precious metals. These are tangible stores of value that do not depend on the stability of any single government or currency. At the same time, corporations and investors adopt similar behavior. When they see countries shifting toward self-reliance, reshoring supply chains, and prioritizing economic security over global efficiency, they adjust their portfolios accordingly. This means increasing exposure to assets that can withstand volatility, inflation, currency devaluation, and geopolitical fragmentation. In moments like these, hedging demand is not driven by fear, it is driven by risk management logic. The objective is simple: preserve purchasing power and reduce vulnerability to political decisions that are beyond the control of businesses or investors. Another important factor is the changing landscape of trade. As nations impose tariffs, restrict technology exports, or compete for resources, the global flow of goods becomes less predictable. Companies raise prices, supply disruptions occur more frequently, and the cost structure of economies becomes more volatile. In such an environment, the value of financial assets tied to stable, low-cost global trade comes under pressure. Investors recognize that the world is moving toward a more fragmented system where regional blocs compete rather than cooperate. This fragmentation increases inflation risk, increases uncertainty, and increases the demand for hedges. Energy security is another driver. As nations seek control over their energy sources and reduce dependence on foreign suppliers, the transition creates price swings, political friction, and strategic vulnerabilities. Energy disruptions can ripple through entire economies, affecting everything from manufacturing to transportation to consumer prices. Investors understand that energy-related risks translate directly into market volatility. That volatility reinforces the need to hold assets that can withstand or benefit from broader structural uncertainty. In periods where global order weakens, the cost of being unhedged rises dramatically. Those who fail to prepare often find themselves reacting to events rather than anticipating them. History shows that wealth is preserved not by predicting geopolitical events, but by understanding the incentives and trajectories that shape them. When nations prioritize security over efficiency, when alliances shift, and when geopolitical rivalries intensify, certain patterns repeat. One of those patterns is a surge in hedging demand by governments, institutions, and individuals who recognize that the world is entering a more unstable and competitive phase. This new chapter of de-globalization doesn't mean the world stops trading or interacting. It means the rules of engagement are changing. It means systems once held together by mutual benefit are increasingly shaped by national interest. And in such a world, the prudent move is not to assume stability, but to prepare for instability. Hedging becomes a rational response to structural uncertainty, a way to navigate a world that is becoming less predictable and more fragmented. In the end, what matters most is recognizing the direction in which the world is moving rather than clinging to assumptions from the past. We are in a period where structural forces, not temporary headlines, are reshaping global dynamics. When systems transition, those who understand the underlying mechanics can adapt early, protect themselves, and even find opportunity in the midst of uncertainty. The goal is not to react emotionally, but to prepare intelligently. By seeing the world as it is, not as we wish it to be, we position ourselves to navigate this new era with clarity, resilience, and a deeper understanding of how to preserve value when the global landscape is undergoing profound change.